Hello, everybody, and welcome to the second week of supply chain management. This is Guyabadi, and I will be looking at a bit more of metrics and different infrastructure related to what makes supply chain management measurable and what frameworks are there to be able to manage a particular supply chain management. Before getting into the lecture, it's very important for you to realize that there is a reason supply chain management is so popular. And then there is a reason why it is so complicated. Because in reality, even though at the end of the day, it is the strategic fit between whatever you do, how you decide, how many facilities, what transportation, how much inventory, where you're going to locate, how you're going to deliver to the customers, what is your inbound looks like, what is your outbound, are you going to outsource, are you going to insource, are you going to create added value within your centers, are you going to have economy of scales as your competitive advantage. There are many, many different issues one has to worry about. So in reality, it sort of covers from very strategic concepts all the way down to nitty-gritty where you have to have financial metrics in trying to make decisions. Now, at this level, we will not look at DuPont model, but you can see that strategies are made based on decisions that come from income statement, comes from balance sheet, being able to make a decision that makes sense. That is why I really, even though I know it is not maybe common practice at an undergraduate course to do so, but please make sure as you read the book, try to put yourself in a position of a manager or a decision maker when it comes to deciding on what mode of supply chain management, what framework, what particular aspects of it you're interested in. And also, please, make sure you write properly. Please use Grammarly. I hate to see you receiving grades that are not what you're working for, because if you have so many grammatical errors, if you don't understand how to interact with one another based on APA standards, you're going to be penalized. And I hate to see that because, again, we're going through this. I know it's a lot of work, but at the same time, it could be very pleasant and it could be really joyful. And you can understand things. At least my hope is by watching what I am presenting to you, you will get a better feel for what is this whole idea about. Again, please make sure that you just don't write something, and if you are planning to use a source, a scholarly source, other sources, make sure that you refer to them. Reference it based on APA. Make sure before posting, you make sure that your writing is at par with what is expected of an educated individual. That's why we've provided you with Grammarly. So please take my advice and make sure that you have Grammarly installed and be a bit more cautious when it comes to posting. With that said, let's get going and start our two chapters, chapter 3 and 4, which are fairly long chapters. And I will try to sort of cover what could be covered within a 90 minutes time. But then again, nothing's going to be replacing what you can get out of by reading. So please make sure that you have a pretty good understanding of what's happening and what's going on. Okay, now we're looking at drivers and metrics. Now, drivers, what drives supply chain, and metrics, how do you measure? How do you make a decision? Because at the end of the day, you're supposed to make decisions. How do you make decisions? What are the metrics? Because at the end of the day, when you want to decide between one or another, there should be some way of measuring, and metrics are very important. So in this week's lecture, we're hoping to be able to show you what are those major financial measures, metrics that one can look into in trying to make decisions. to look at what drivers are there for supply chain management. And again, very important, supply chain strategy and competitive strategy, right? These are strategies, one created to make sure the other one comes true, right? So the whole idea is to be able to look at what makes you who you are, what makes a particular corporation be successful, and then make sure that there is a strategic fit between their supply chain management. So that is why it's very important when we look at it from key performance metrics, from issues related to inventory, transportation. So we're going to look at all those aspects, especially the flow of information, because we've looked at it last time, and without appropriate flow of information, timely flow of information, one will not be able to do much. So it's very important to be able to understand that it's not just about sourcing, but a congruent sourcing that goes from suppliers all the way to the customers and in between, with the proper flow of information and appropriate use of transportation. So that is very important to understand that it is, at the end of the day, the type of competitive advantage. Are you a low price, easy to go, or a high price, high class, responsive? So these are important issues you want to be aware of. There are many issues. Now, let's start with the most important, people who own a company, right? We call them the shareholders, the ones who put their money to create a corporation, a company. Now, what they are looking for is the return on the equity they have. So how much money they've put, they expect a certain return, right? Otherwise, they would take their money and go buy stocks. Now, you might say stocks are not doing well today. Still, the financial market has standards. So you can go to S&P 500, NASDAQ, whatever, and buy stocks. And usually, you have a certain return on equity. So if you have money, you expect a certain return considering the amount of risk you're taking. Now, what is return of equity? Is the net income you get to the average shareholder equity. That's how you go in trying to see, is it a sensible investment or not? And usually we need to stick to this. People who invest, shareholders, because most of these companies, shareholders have nothing to do on a day-to-day operation. Therefore, as a manager, one has to be cognizant of the fact that shareholders care on their ROE. Also, as a manager, you want to make sure that your company is managed properly. How do you do that? What is the return on the assets you have at your disposal? So return on asset, or ROA, is a good measure of how well a company is run. So we look at EBI rather than EBIT, which means earning before interest. Now, some people don't look at it like that, but what we mean by earning before interest is you have to take the interest expense and one minus the tax return, what rate it is, and take it out. Now, that is from the net income that you have made. So final income, which is net income. Now, some other people have a tendency to look at ROA as just simply net income over average total asset. But in this book, the initial definition, namely this earning before interest, is being used. Now, there are pros and cons about using this particular measure, but for as far as you're concerned and you want to do calculations for your quiz and for your exam, make sure that you're aware of earning before interest is what is used, not the net income. And then we have something called accounts payable turnover. Now, what that means is, whenever, remember, you have gross from when you see the revenue and take the cost of goods sold, right? Always cost of goods sold is taken away from that, and you look at the accounts payable. So in a way, you're looking, this ratio looks at your financial leverage and sees how solid you are, and we'll see how they are interrelated. Another issue that can be very important here is this, like when you take that asset turnover that initially we saw and profit margin where everyone understands. So in a way, the return on asset has two aspects to it, both the profit margin, how profitable you are, and how well do you use the assets at your disposal. That's why even though you can see sales revenue is canceled from the denominator to the numerator of the second term, but at the same time, in reality, return on asset has both views in there. Both views are present, meaning profit margin as well as asset turnover, and we'll see how they are measured. Now, another key component are this, so referred to as ART, or account receivable turnover, sales revenue over accounts receivable, as well as you look at inventory, because again, as a corporation, you have a certain amount of inventory and you want to see how well your cost of goods sold related to the inventories you are keeping, what is that ratio? And obviously very important, that is property, plant, and equipment turnover, because again, these are the amount of money that has been invested into a corporation. So as you can see, there are many measures. Make sure you understand them. Make sure you go through the example. Again, I'm going to right now share an example with you between Amazon and another company, just for you to see how they measure one against another. And by the way, I already have just taken a snapshot to see why Amazon is more sound, because of the fact that it has such low volume, low values, but on a very, very high volume. Another one is C2C, or cash to cash. This cycle is a good measure that looks at how long in average does it take for when a cash comes into a process, you put cash into there, and then when do you get your cash back? So you put money, is a machinery, you look at that, so you can see, you look at your weeks that it takes for your receivable, weeks that it takes for your inventory, and then you take weeks of your payable, subtract it from it, and then you come up with a C2C. So these are another measures of seeing how quickly, what is your turnover, your cash turnover, how quickly you churn the cash available to you. Now, as I said, I'm looking and comparing Amazon.com with Nordstrom, and both of them right here, you can see one obviously much larger than the other, about 6 times larger, and even that number has gone through the roof. I mean, on the Amazon side, and now it's about 120 some right now. The total revenue, you're looking at 74 versus, and these are, so we're looking, I believe this is, the numbers are in thousands here. So we're talking about not millions, but billions that we're having turnover here. And when you take the revenue that comes to the corporation, and you take the cost of goods sold, and you subtract that from it, as I said, you get to your gross profit. Now, gross profit, you get here 20 billion here, and you get 4 billion there. But in reality, what you see here is a much larger gross profit when it comes to Amazon, because it's a much larger operations, right? So that's about almost 6 times the volume of Amazon versus Nordstrom. But when you get down there, you see that now gross profit is not that ratio of 6 anymore. It's actually about 5. And why? Because of the fact that cost of goods sold on Nordstrom is less comparatively to what Amazon's spending. And so when you get to SG&A, that's the amount that you spend on your overhead for selling, general, and administrative, and you take those down, and you see that number gets to be even much different right now. You started with 6 times the revenue when it came to comparing Amazon to Nordstrom, but then when you come to operating income, and you see right here, actually Amazon's operating income is lower, even though it was 6 times higher, but it becomes 0.5 of what Nordstrom. So Nordstrom, at least based on these numbers, again, you might say, how are they doing now? Please go take a look at it. I was just looking at Nordstrom went from like 40 all the way down to about 18. So post-corona, things are not going to look. But interestingly, Amazon has increased and stays to be steady. Now, you look at operating income and you see one, because of the fact that, and again, we're looking at two companies just to show you different strategies result in different financial metrics. Now, total other income, you can see there are some losses on Amazon side where it doesn't apply there. So earning before interest and tax, this is referred to EBIT. EBIT, meaning earning before interest and tax. That's a very strong measure. Usually when you want to look at how much a company is worth, you look at EBIT. And you can see, again, that ratio almost now, even though it was 6 times for Amazon, here we're seeing that EBIT is about half of what Nordstrom is when it comes to Amazon. And then the obviously expenses related to interest, you take that, and then you come up and you look at the income before tax for it to be, again, keeping that half in there. And after you take the income tax expense, so you're looking at a net income of 274 versus 613, right? And now even that net income, don't forget, we started with a revenue of 6 times on Amazon side in comparison to Nordstrom, but now we've come down to almost about 40%. So now look at on the asset side. Asset side, we're looking at 8 billion give and take here and 1.2 billion there, 8.6. A lot more assets on the Amazon side. Again, you can see that number is there, that the ratio of 6 is there. And then you look at short-term investments, which usually, by the way, let me tell you something about Amazon. There is a reason Amazon has become the largest company, because actually from beginning, their idea was not how much profit margin they have or how much money they make, but how quickly they grow. So they're willing to go into markets even if they lose money. So you look at their inventory, again, that ratio of 6 is kept in there. And then you take that and take the other current assets they might have. Now, Amazon has none, but you see Nordstrom has that 80,000 here. Again, don't forget there's a factor of 1,000 missing here, if I'm not mistaken. So the total current assets, Amazon 24 and Nordstrom 5.5. So again, that ratio of even larger than 6, larger than 6, lower than 6, I'm sorry, about 4 point something, 5 point something, 4.89. So you multiply 5 times 4.89 and you get the 24. So you can see again, Amazon is a much larger entity than is Nordstrom. And then you look at PP&E and you goodwill, these are the values. So the total assets on Amazon is 40 billion. I'm not sure on that billion. I think the vote is out. Is it? I think so, but. And then versus 8. And now when you look at liabilities and stockholder equity, and you look at accounts payable, there is 21 billion here, 1.4 billion there, a lot smaller and more agile organization here, where you take those and you come up with a total liability of 30.4 on Amazon, where you get to Nordstrom, that factor of almost 5 is there, 6.1, where you get to your total stockholder equity. Remember, that's what a lot of investors are interested. They look at the total stockholders equity to see what are the returns they're receiving on that. So one is around 10 and the other one is around 2. Again, that factor of 5 is visible here. Now, looking at these two particular organizations, when you try to make a decision when it comes to models and formats and investments and paradigms of deciding what sort of supply chain you're going to have, you first need to have certain metrics to begin with, because when you come up with an idea, when you're trying to decide, you have to see how does it affect any of these measures, because the effects will be, as I said, DuPont is one of those models where you look at two different aspects, one from income statement, one the other from balance sheet, and then you multiply it to see what kind of return you have on assets and how does your decision improve or reduces the attractiveness of a particular organization, and is it a good strategic fit or not. Now, just for you to be able to look at this, you're looking at ROE that was introduced before, that's return on equity, return on assets, and you take these things and then you subtract them from one another, you get ROFL, which all you have to do is take the 2.81 and subtract 0.91 from it, which you get to that 1.9%. That's a very, so that's return on equity minus return on asset. And then, so you can see it's 1.9 versus 28.05. Now that's a major difference here. That major difference in itself is worth your attention. Sorry about that. So again, as I said, you take the return on equity, where you take the net income on average shareholder equity, and you look at your return on asset, which is earning before interest to average total asset, and you subtract them from each other, and you get exactly to ROFL. And then interest, look at this one, profit margin, as I said, something that we look at earnings before interest versus how much revenue you've generated from sales, and asset turnover, which again, sales, looking at total asset. Remember I said ROA has both of these in it, within it. So when you're looking, that's why ROA is such a crucial metric to look at, because even though you have earning before interest over average total asset, but look, it is a multiplication of profit margin, which you have that earning before interest, looking from how much revenue you're generating. So looking at the sales revenue, and then if you notice, if you multiply profit margin by asset turnover, what do you get? That's why I said ROA is a very important metric, and you can use it. So if you multiply them together, you obviously get back to your ROA. So ROA has both profit margin in it as well as the asset turnover. And other metrics that are used here, one is, remember we looked at this thing, so we're looking at cost of goods sold versus accounts payable. We look at sales revenue versus accounts receivable. So you're looking at the inventory, you're looking at plants and equipment. So you're looking at sales revenue over PP&E. And these numbers will all tell you, and as you can compare here, Amazon versus Nordstrom, and you can see that it's very important to keep in mind that we have significant differences depending on the strategies they have chosen to. So again, when you're looking at account receivable turnover and versus like inventory turnover, and you compare these two, you see that account receivable turnover, the number is 15.62, which is much higher than, so they're managing their supply chain much better and faster in comparison to Nordstrom. or inventory turnover, you can see even their inventory turnover, as one would have expected, Amazon is higher, but then again, their profit margin is lower. So you can see that equipment and plant and property turnover, you see again, it's a higher number for Amazon. So Amazon is much more agile, but then again, with a much lower profit margin. Two different models will give you two different metrics, and that's very important to pay attention to. One model, you're looking at accounts payable turnover in a different way, and so you can see numbers are, one is higher when that comes to APT, but then when you're looking at ART, this one churns faster. Again, as I was saying, maybe I can share with you right now the latest performance of these two companies, just to get an idea that when you're making these sort of decisions, and I will finish, as soon as I finish this one, I will share those two data for your understanding, to see how different strategies and different models and different frameworks in supply chain management will produce different metrics. And one has to decide. That's why it really is not just a decision that is abstract in nature, but it really depends on the strategy of a company or a corporation. Depends on what are the goals. As I said, Amazon is not there to make a big killing. It's not there to make a lot of profit. Amazon's there to churn this as fast as possible, to look at, as a matter of fact, when you look at C2C, cash to cash, you can see that it's a negative number compared to that almost 12 weeks, right? So that's a 3 months delay right there in comparison to that. And even though their SG&A are almost identical, well, look at that cash to cash. There's a reason we see Amazon continue to prosper due to these different models and different methods and frameworks they are using for their supply chain. And by the way, when it comes to Amazon, actually the same applies to Nordstrom. These are fairly good comparison with absolutely two different strategies and two different ways of going about choosing their supply chain management. Hopefully, you can see that the type of decisions you make on what type and what mixture and what format of supply chain management produces so totally different results. So, as I was saying, so when you look at numbers, account payable turnover on Amazon, 2.48 versus Nordstrom, 7.35, right? Where on the other hand, accounts receivable is much, much higher when it comes to, and that's the secret, right? That's the secret of Amazon. So inventory turnover, look at here again. So all in all, you can see based on a particular strategy with the same SG&A, even though the numbers, don't forget, 6 times higher, right? 74 versus 12. Still, Amazon is doing well. And if you want to, let's just take a second and take a look at how they are doing in terms of their stock here. I just took the time to look at it. Look, this is what happened to Nordstrom, right? Nordstrom, you can look at it. December was around $40, as I said, right? It got to $40 and down. And look how low it went. It went all the way down to numbers of $13, or today at $17, right? So see what a volatile issues, because it was a high profit, but guess what? It's losing a lot of money. It has lost over 60% of its value from $40. Where you look at Amazon, right, for the same period, look what happened. It started, like, if you look at December and you look at what they have done, this one is not responsive enough. So you look at December, they were at $1,800, Look at here, $2,400. So again, very, very complicated, very dynamic, very interesting. So it's not just simply looking at these numbers, but also understanding that their strategy, their competitive strategy makes all the difference, right? One organization, 6 times the other from turnover point of view. But one organization is doing so much better when it comes to these metrics. And as you can see, it's not just because, yes, you might say uh, everyone had to deal with a shutdown. Yes, that is true. And that's another part of the strategy uh, position and the level of strategic competence a particular organization has, but they all come down to how you decide to manage your most important aspect of your organization. How do you go from suppliers all the way to customers in a very reasonable and robust manner? So that is very, very important for one to realize and understand. So please make sure that you do realize this one. Now, when you're looking at different industries, there are certain financial metrics. Now, these are across all industries from 2000 to 2012, and you look at you look at numbers. You know, the margins to cash to inventory turns or SG&A, and look at it, and you can see different industries have different numbers, and these are there. So they come from the financial market for you to be able to use it as guidelines. So not just metrics have been very useful, but also metrics from one industry to another might vary differently. Look at it, automotive to 0.04 to pharmaceutical to 0.25. So you can see the variation, right? 6-fold variation. But you can see again C2C from the cycles of very, very long cycles to 211 to as short as 9.3. So again, different industries have different averages, and one has to be cognizant of these differences when you're deciding. So you do need to know what particular market you're operating in. Like, look at the average inventory turnovers, right? You look at consumer electronics, 43, that's huge, right? Huge, 20 times. Or you look at the SG&A. SG&A, you can see at the chemical is very, very low, right? So these are extremely important to understand that each industry has its own standard metrics, and one should not compare one industry to another, but take those metrics and compare them to their corresponding industry standards. So that's very, very important. That's why another issue when you look at these financial measures of performance, it's very important to understand that at the end of the day, when these things don't work out, because don't forget, supply chain meaning, how do I see the future so I supply what I think the customer is going to want, what I think the customer's demand going to be. So it is there at the lowest possible price, at the fastest possible delivery. So these are the issues. And that's why these things don't take the fact that how about if you make a mistake? You make a mistake, you have to put up with markdowns and a lot of lost sales, because markdowns is when you put too much in there, hoping they're gonna buy, and guess what? The demand, you were wrong, it's not as high as you thought. Or demand was much higher than you would have imagined, and then you have shortages. So markdowns and lost sales, these are those uncertainties that one cannot ever be sure of. So very important. There are many metrics that you have to keep in mind. from profit margin to accounts payable, ARTs, APTs to markdown and loss. There are many aspects. And these are those guidelines and rules that you have to watch out for when you are making decisions on a particular aspect of supply chain management, methodology, technique, or tactics even. So it's very important. That's why everything starts with competitive strategy. What is that competitive strategy? Like I just showed you two different markets. Along the same line, one high profit margin, one very low profit margin, but one much more robust compared to the other. So you look in line with what the competitive strategy is, supply chain strategy has to be developed for what we call strategic fit. And in line with all those metrics that are very specific. And you always have to watch out. If you're looking for efficiency, that means you're looking to reduce cost. Hence Amazon. If you're looking at responsiveness and being to keep your customers satisfied, you put up with expenses and a lot of, so there are, in here between the things that the drivers that get these logistical processes going to other issues, which is, how well do you maintain and interact with your customers, which really in reality, when you look at from raw material all the way to goods at the hand of customers, there are facilities. Are they going to be in one single place and you go from here and deliver it to your customers? It's going to take a long time. Do you have patient customers who are willing to wait for it? You might, if the price is right? Inventory, are you going to be able to satisfy what your customers demand? Transportation, how are you going to do it? Are you going to have transportation, the inbound, is it going to be inexpensive? The outbound, is it going to be expensive or inexpensive? Would your customers put up with receiving their orders in many different times, depending, let's say if they order 5, 6, you might have to source it from different facilities. Now, very important, information. What kind of information system, how much your suppliers are allowed to have access to your logistic and supply chain, so that, remember, supply relationship management, how much is it integrated, sourcing, do you have a single, multiple sourcing, and again, the pricing strategies. There are a lot of issues you have to understand and take care of. So, and again, I cannot cover all of these, especially chapter 3 in one session, let alone chapter 3 and 4. I do invite you to take some time and read the book. It's a beautiful book. I think you guys are going to enjoy it, and it will stay with you, even though you might feel it's a lot of reading. It's not really. I mean, if you get interested, you'll be amazed how much you know. Why a party list? What's the difference between Walmart and Kmart or Amazon or Nordstrom or whoever, right? That's nice to be able to see that. So remember, there were two aspects. One was on the left-hand side were the logistical drivers, and on the right-hand side was the cross-functional. And each of these facilities, inventory to pricing and information, and what are the overall supply chain performance looks like, and how do you decide on these things? So it's very important to understand that at the end of the day, supply chain design and frameworks and is to make sure that you have everything designed properly to match your strategic competitive advantages and strategic directions within an organization. There is not one solution fits all, depending on what you are planning to do, how you're planning to keep your customers. Are you offering them very low price, but they might have to wait? Or are you offering them quick responsive type of services, but they'd be paying higher prices? Just compare Walmart versus Target. People are paying about 10% higher for target for whatever reason they do. Now, when you look at each of these, when you look at the supply chain and you look at facility, where and how many of these facilities you have, these physical locations, will definitely play an important part. Do you try to stay as modular as possible? Do you put finished products in there? What kind of variety you put in there? How you store them? Like, for example, you look at IKEA and how they try to stay until the very last moment by keeping very standardized modular designs. Your inventory, from raw material all the way to finished good, how do they interact with the supply chain functions as a whole? And again, transportation, both inbound, where you take it to a distribution center, or do you even have something sold and have it directly shipped from the manufacturer or OEM? These are the issues. So how do you go from point A, where is the manufacturer, all the way to the customer? Do you bring it in a central location where it's close to your customers, or do you just deliver it from? And when it comes for for the performance and cross-functional ones, where information is the most important aspect of supply chain management, because what it does, it brings everything together. As a matter of fact, with the appropriate information system, one can play strategic games to know when to give markdowns, what times are good time, how much do you store, how do you determine how much to put where, how many of particular size or color of a particular product would you like to store in what part of the country or in what facility. Now, another issue is related to sourcing. How a particular supply chain activity is going to be sourced. Is it a single, multiple? And especially when you're looking at it from a global point of view, and what kind of customer and what are they willing to pay for it. Pricing strategy differs from one to another. Pricing strategy of iPhones are different than pricing strategies of Samsung. Different organizations, their competitive advantage relies heavily on their pricing. So, facilities, and you can take a look at like Amazon, like Walmart, they have these major centers all over the country trying to make sure that as soon as you put a order in, you get what you want within a couple of days. Some people are not willing to wait 2 weeks. They want to get fast delivery of a day, overnight sometimes. So facilities, and how many of them within a target market that you have, be the nation or international, this determines how fast and responsive you are to your customer demand and how fast you can do that. Now, there are many, many metrics, but what you see in here, these 7 metrics of capacity utilization, how do you look at your processing setup to quality losses, as well as production cost per unit, and then here comes the economy of scale, and a lot of issues related to remember we had that push and pull, so you're looking at this flow cycle time, both because you're looking into the future, so you want to see what models you're using, and then you take those models and theoretical frameworks and see how do they match with actual averages, and then how do you correct them to be able to predict the future. And again, on inventory, the role in the supply chain. What you look at, when you're looking at inventory, you're looking at customer demands and how quickly and how can you easily respond to their demands, but at the same time, make sure you have volumes that make sense. So that's that economy of scale to be able to reduce, or at least when it comes to SG&As, because SG&As really relate to how much you're selling and what is your inventory. So a lot of issues with responsiveness, cost, and all other issues, which brings, what is how much should you have in a particular, how much of a particular product you need to store, you need to have ready when that is the push part, to make sure that when the pool starts, you will not lose any sales, and looking at things that are more clear, such as seasonal events, what is the fill rate? Again, like look at Walmart, how their fill rate works. That's one of the fastest. And then looking at how much are you going to be allowed to have out of stock and still not lose your customers to your competitors. And what do you do with your obsolete inventories? And that in itself is a huge, huge area of activities where you got secondary markets, you got obsolete markets. So, and again, when it comes to transportation, there are two aspects, actually three aspects. One is inbound to your facility, and usually you do that in bulk. Then it's outbound, and then the last mile. How do you manage these things? How do you create a good, responsive yet inexpensive way of getting the product, the customer orders from your warehouses and facilities or your suppliers to the final location, to be able to find the right balance between cost or efficiency and responsiveness, to be able to have a best strategic fit. So there are many modes, how you do it, where do you go with air, under what condition, where do you use a railroad, sea, depending on international components that might be coming. And for example, when, let's say, you're looking at options, the ships that carry all these containers, sometimes last minute, the empty spaces are so inexpensive. That's why competitors from China actually are competing here while all their expenses is in China. So again, depending on what kind of customer base you're looking, what kind of speed you're looking, what kind of responsiveness you're looking for, what are the strategies about your pricing. So there are many, many costs that you need to keep in mind, from transportation, shipping, what kind of size can you use empty spaces on a last minute to per shipment, how much do you cost, what are the economy of scales you're using. And these are very important trade-offs that you have to watch out, because at the end of the day, how quickly do you fulfill a customer's requirement, hence responsiveness, versus how inexpensive that is going to be. So how efficient are you? And as we say efficient, that means it's not going to happen USA, maybe it's happening in India, China, other places. So how much do you keep considering the holding cost? And so these are very important. And because there's so much information, you need information. You need very good and reliable information to be able to make decisions, because information technology is right now what makes the global supply chain a success story. I don't care what company you're looking at. So in reality, information is the name of the game, right? Without it, there is no possible way for anyone to be able to maintain supply chain management globally. That's where one, not just availability of information for particular instance of time to be able to decide, but also enough information to be able to do regression analysis, to be able to look at past historical data to predict the future. So a lot of those estimation and forecasting is only possible because of the information systems in there. And so it is not just the issue of coordination to make sure that things are happening and demands are being met and shelves are being filled and inventories are at par with what is expected, but also to be able to do information processing. And from there comes the more difficult aspect, sales. How do you plan operation? How do you plan sales? You know, what level of demand you're predicting? How much are you going to be ordering? How are you going to be managing the operations? And these are a lot of issues that has to do with, you know, are you looking at quarterly, depending on the type of market you're in, you know, what are you looking into? Are you looking for next season? Are you looking for next year? Are you in car manufacturing? Are you in pharmaceutical? Are you looking to find the to the corona or COVID-19 outbreak? So how do you deal, you know, how much of that error can you tolerate? How much of markdown or loss of sale can you operate? Where do you put that point of push versus pull? And these are the issues that you look at, the variability and viability of these things. So it's very, very important to make sure that you understand the flow of information is more than just flow of information, but information that allows you to look into the future. And sourcing, you know, these are major issues. Sourcing, and go look at any of these major players from Amazon to Walmart to Kmart to even Starbucks. What they do is they look at how they deal with a third party, what kind of quality, how do they pay them, what is the cash to cash in there, you know, how to deal with the things that are not sold. Are they being sent back? Are they going to be paid for? Are they part of the liquidation process or markdown? And, you know, how do you decide to look at the sourcing, and how do you bring sourcing as a third party and integrate it to within your supply chain, so that you cover them? Because if they die, you die, because sometimes you depend on them. If they cannot afford to source when you need them, then so this is more than just a customer or a supplier, but a stakeholder that you need their cooperation and collaboration and integration of all of that supply relationship management system that allows you to look beyond just the interaction. Now, this has to do, sometimes you pay people who source for you ahead of time, because if you don't, they won't be able to source so that you can answer demands when needed. And there are many metrics in sourcing as well, right? You know, what are the measurements of how long are they willing to wait to be paid? Are you going to first get money from your customer and pay them? Do you want to pay them ahead? So, and how do you, I mean, the economy of scale, what is average purchase price, you know, the kind of quality, who pays for returns, what are the quality measures you put in them, what kind of lead time, when do you get push going, meaning you order for predicted demand, and when and how fast and how quickly would they respond to your pull, meaning when demand is generated and customers in there, and issues related, especially if you let them ship directly to a customer for on-time delivery and their reliability to be able to fulfill what they need. And most important, pricing, right? Pricing is what we already saw in an opening example, the difference between two major entities, right? Pricing, because in reality, profits are generated differently. Profit margins are going to be determining factor, but you notice high profit margins sometimes are not very stable and you cannot maintain them. So when you come to pricing, it all it all boils down to economy of scale. I mean, if you're a major player such as Walmart or Amazon, obviously you can afford to sell at a much lower profit margin because of that economy of scale. Also, you happen to source at a much lower price. So it's very, very important to distinguish between those who are everyday low price, such as Amazon and Walmart, and those who are high quality, high price, such as Apple and alike. And how do you do that? Nordstrom and Bloomingdale's of the market. So there are many metrics in there, and we already have taken a look at from profit margin to range of periodic sales, from sale price to fixed price per order, how you break these things down, SG&A, and all of those things. So that's chapter 3. Again, there is no way for me to do justice for a chapter. Now, please make sure you take the book and read it. Make sure you read the book. I don't care if you got this version or this version. I am reading it, okay? It's very important. I am reading this book. Make sure, I don't care which version you're keeping, read it. Interesting. Now, some of us have to read more, some of us less, but without reading, there is no way for you to know. This lecture alone will not cut it for you. Now, in chapter 4, we're looking at when you design that network from a supplier or raw material all the way to the end customer. How do you design? There are different options. There are different methodologies. What are the pros and cons, weaknesses and strength of each of these, and how do they relate to the strategic market you're looking and your responsiveness? Now, issue of distribution is the name of the game, right? You go and distribute it because no one's gonna be producing per customer, right? The job of these corporations really in reality is to create a brand trust where people go to buy things. So the question is, how do you distribute all these things that come to you in prediction and in planning and in forecasting the kind of demand that you can generate depending as how much of target market do you have, how many customers, and how reliable your forecastings are. So the issue really in here is how do you decide and what kind of strategies do you have from efficient, very low cost to very responsive, high cost? Where do you fall within your target market and your customer? So when you're looking at your distribution network, you have to go back to the basic of business. What are you offering to your customers? Why customers are buying from you? What are your core competencies? Competitive advantage, because in reality, different needs means different pricing, different strategy, different competitive advantage. And it is that where the whole idea of distribution network comes from, because distribution networks have different performances depending on issues that I just told you about. And you have to look at the type of customers and expectations your customers have and the kind of revenue you can generate from that particular customer base. Because if you cannot pay and if you don't have the surplus that your supply chain system or network is going to generate, if you don't have a surplus, you're not going to stay in business for long, as we've seen that. So, these are issues that are very important from, how quickly, how much are they willing, the type of variety there. Like, as I said last time, you go to Costco, not much variety. So different customer needs, different customer pattern and behavior, product availability to, if you're looking for better customer experience, or you don't care that much for that. That's the difference between Target and Walmart, right? And time to market, or, how people can track and both, when I say people, I don't mean just customers, suppliers, managers, planners, and then how quickly, if customers are not happy, because if they don't trust that they can return, they ain't gonna buy. So very important to look at issues related to how much do you keep in what place and what location and how close to a customer, and what kind of information available both to within the corporation to the customers as well as to your partners and suppliers. So, and if you can see right here in this graph, what you see is the desired response time and number of facilities. Obviously, if you need to have a quick response, you better have a lot of facilities close enough to your customer. If you don't want to have that, if you want to go to central locations, time is going to take, and that graph really tells you, and you have to make decisions around the graph like that, which determines, and it's a good place, depending on what your customers are looking for in response time, you can see what numbers of facilities you require to do. Again, inventory costs and number of facility. You know, if you have many facilities, that means you have to put a lot of material in many different places. The cost of inventory will go higher. Where if you only have one place, one location, obviously inventory cost is much lower because now you don't have to repeat and have a redundant inventory all over the place. But then again, people have to wait for them. So if people are willing to wait 2 weeks to do that, and interesting about the transportation cost, right? Transportation cost and number of facilities, first it reduces, right? Obvious, because you know, if you got only very few facilities, transportation cost is high. Why? Because you have to send it to so many different places and because number of facilities reduced, then you have to pay for transportation costs. So the more facilities, the more spread your facilities are, the lower the price. But then afterward, now the transportation cost goes up because now the inbound transportation goes up. So you see, there is a balance, and depending again on the type of response time you're looking for your customers, you have to make a decision where on this graph you want to wind up. So another issue, when you look at the cost of even maintaining facilities, because facilities are not just places, there are people working in their shelves and maintenance of such facilities. And obviously, the more facilities, the higher you have to pay for facility costs, and they have a direct effect on that ROA that we were looking at to begin with. So, and when you look at, here there are two graphs, you can see response time. Do you want to have low or high response time? Obviously, if you want to have a low response time, everything is high. But if you want to go and people or customers are willing to accept 4, 5, 6, 11, 2 weeks delay in their order, then obviously the cost can come down. But interestingly, the total logistic cost is a funny thing. You know, it's high if number of facilities are low, and it's high if number of facilities, and as I said, because really the balance between inbound and outbound. So, and you can see, again, you have to make decisions now. At least understanding that these are the dynamics that are involved here. So when you're looking at distribution networks and seeing how you want to do that, first issue is what kind of customers? Do they want it to be delivered to their houses, or are they going to go pick it up? That's totally different, because that's got, especially the last mile, usually is a highly costly decision. So, and then would you allow the producers or the suppliers to directly ship to the customers, or do you need to go through intermediaries? Again, major decision in there. So that's why when it comes to optimizing and finding a good distribution network, one of these 6 you have to look at, right? You can either store with direct shipping, or manufacturer has in-transit merge. So sometimes things happen here and there and they combine it together and merge it. Or you have a carrier delivery, or you might allow the last mile to be delivered by U-Haul, or who I said U-Haul, sorry, FedEx, or other USPS. So, or you're looking at storages and places where right now you've seen these Amazon centers where you can, customers can go and pick up from that location. Or you might even allow retailers to store and allow and use the retailer facilities and locations as a place where customers can pick. So you can right now see it in here. So you have all these manufacturers and all these customers that really the job of the firm is to get customers connected to the manufacturers. And then the retailer, what it does, it just looks at the product flow can go directly from manufacturer to a customer, and all the retailer does is manage this whole process of supply chain management and mainly information management, nothing more. It's just a flow of information. So there are many cost factors here, from inventory to so these cost factors are standard, right? We already have seen it: inventory, transportation, facilities and handling, and information. And you look at here, and when you have these different options of the 6 that we discussed, when you have manufacturer store with direct shipping, it has obviously inventory is lower cost because you don't have to worry about inventory, but transportation cost goes up. And so because you don't need to go and create places to store, because that means a lower facility cost. And but you need to make sure, because right now your only or the firm's only relevant role is to make sure information flows correctly and accurately, and that is where a fair amount of investment is required in the flow of information, and that's very important. Now, when you look at this system, so the response time to product variety, all of that, for sure, when you're doing that, because you don't know where the manufacturer might be, so it might be long response time, right? And usually 1 to 2 weeks we're looking. But because it's manufacturer and the customer, variety can easily go up, because now we have this ability, and really all you are is a middleman between the customer and the manufacturer, and that's why it's very so. And product availability, again, is resolved between customer and manufacturer. So, and you can easily take the hands of customers and put it in the hand of manufacturers. You're there, the position and place of a organization is kept solid. Hence, you can have a very fast time to market delivery, which but unfortunately, when it comes to visibility, it's not that easy to have that done. Now, a lot of work goes in there, because in reality, it is when you're looking at visibility, the perspective, it belongs to the end customer, and that's not that easy. And usually, and if you've ever bought in such a situation, return becomes extremely expensive, and it's manufacturers don't like to take things back. You don't have a single place to go and contact, and customer service becomes an issue. That's one of the biggest drawbacks of this technique. Now, another one is when you have these so-called in-transit merge networks, right? So you have factories that come into this through certain carriers. They come to a place and then they're sent out to customers. And again, retailer only has that informational control over what's happening and how customers satisfied. In here, again, the inventory is almost the same, because again, you're looking at the manufacturer, just they're coming and merging. Because there's a central location and there's merge happens, because of the merge, the price of transportation is reduced somewhat. But facility. Now you got facility, so price goes up in there. And again, you need to, more than just between the customers and manufacturer, also facility and these merging activities, which means higher cost in information systems. Response time, not much different. Product variety, again, you're in the same boat to begin with. Same as product availability. Most of these things really don't change. The only thing that happens here, because of this merging, because now you don't have to receive 10 different orders because you went in there and filled up your shopping cart, you're going to receive one single delivery rather than multiple deliveries, which a lot of customers are not happy with. Now, distributor storage with carrier delivery, this is totally different. Now, this you're talking about a warehouse by distributor or retailer that everything comes there and everything moves out from there. So in here, you really have this so-called supply relationship management and supplier management from factories into the warehouse, and the rest really, everything else is happening through warehouse. A fair amount of control here is given to the distributor and retailer. So obviously inventory goes through the roof. Now you have to predict demands. So in a way, there is that push. So you're putting things in there, and there are a fair amount, not depending on what you're dealing. Is it a fast moving? Is it a slow moving? But still higher cost when it comes to inventory. Obviously, transportation is the cost and performance is actually there is a fast moving items, you can have a reduction, but when you come to the manufacturer storage, it's lower, the transportation. Facility and handling becomes higher because now you really have a place you have to manage and control and operations in there. And because now you have a single place where everything comes, you're not as critical when it comes to your information flow. Here, response time could be very fast, depending, because now you've got a single location or locations under your control. We shouldn't say single. Now, because now you're not connected to the manufacturer, you don't have the variety you would have where you had the customers talking to the manufacturer. Product availability is really, you cannot match the same level of customers talking to the manufacturer, because if you want to have the same, you really have to have a lot available in your center. But the customer experience is much, much better, because now you really have that control over how customers see you rather than the manufacturer and their flaws. And usually manufacturers are not pretty good with customers. Now, time to market becomes higher because it has to come. There's the intermediary here that is real, but now you have easily, you can have order visibility because now you got this place under, I mean, control has gone up. So easily you can do returnability. That's also a very good way. Now, this other method where distributor storage with last mile delivery, where in reality, you go into centers and then from those centers, you have the last mile managed. Now that's much easier. And as you can see here, round the robin type of activities where you have these distribution centers all over the place. And here you have certain control. So it's like the best of both worlds. Inventory obviously is high because now you got all these distribution centers there. Extremely high when it comes to transportation, and facility cost is again higher because now you got that distribution in there. Not much difference because now you have the same level of information requirement as you did as before. Where now you got quick response time, right? So, and because of that, again, you don't have the same product variety as you had before, and availability is going to be expensive if you want to meet what manufacturer would have allowed. Time to market is a bit longer, but customer experience is very good here. especially for bulky items, much easier, and returnability is much easier, and order visibility, it's really not too difficult to implement, right? So it is possible to do that. And then you got this manufacturer or distributor storage with customer pickup, where now customers go there and pick up. So you don't have that delivery. These pickup sites, and we've seen this being used especially by Amazon, and it's been a very good success story where now you got customers moving to centers, and usually these are not very expensive, but still adds to the cost. So everyone is aware. I mean, there's a lot of information flow, and there are some cross-docks distribution centers, where in here now, in really from inventory, it's almost the same. Transportation now becomes much less because now you got the customers going there, but facility cost goes up for sure, depending on what kind of model they use and how the customer pickup locations are. And here now you need to manage between many people. If you've gone to like Amazon places, you see now they got these single identification numbers where you walk in, you put the number in there. So response time, not much different between package carrier delivery, same as before, because still you got that in between the manufacturer and the customer, same as product availability. Experience is not as good because things are not being delivered. Customers do have to go and pick up, and that in itself has its own drawbacks. Time to market, not as fast as initial, but not bad. Order visibility is not that easy, as I said, to know when, how to go pick up. Now we're seeing some automated forms of this, where some close neighborhoods are using it, as well as some of these pickup locations per firm, such as Amazon, but it's difficult to implement. But good thing is it's a place you can, if you don't want something, to return, so it's not too difficult. When you go to the retail storage with customer pickup, now these are a lot of both Amazon as well as some of these furniture places, or I mean, some of the, again, as a hybrid location for Walmart, and different places are using this model. Again, you got customers moving, customers can be informed. Inventory, again, goes up here. Transportation is reduced. Facility is higher, and information. There are certain, I mean, information, again, here is fairly intensive, but response time, perfect. I mean, same day. Product variety, obviously you can't, because you're not dealing with the manufacturer. The product availability obviously is more expensive now if you want to have a lot more options, because now you have to store, and sometimes, and depending on the agreement between the retailer and the manufacturer on markdowns and leftover and prediction errors, so that becomes different depending on a particular customer. It could be positive or negative, and but time to market, this is the best, the highest you can get, and obviously product visibility, come on, trivial, right? And much easier for returnability. So you can look at this performance rank of delivery network designs, and you can see, and you can decide which ones best fit. And as you can see, distributor storage with last mile delivery seems to be doing pretty good, so that the combination is, that's 8 if you compare, and the very first one, which is 9. So depending on where you're going, because you got, just I'm looking at numbers added to retail storage with customer pickup, then get the distributor storage with last mile delivery gets an 8, and then 7s and 6s there. And when it comes to performance of these designs, when you look at customer experience and you add all of this up, then you'll see which ones you can. Again, it's not as easy. It's not say, okay, if that's the case, I'm gonna add this up and say, okay, here on this, let's say on the last item, I'm receiving 14 in combination to that 6, that's 20. It's the highest number I might get. Not really, not really at all. You really depend, it really depends on the strategic fit. So you do have to keep track of the pros and cons of each of these to see that they have been ranked, and each of them you need to understand how their performance are for different products, for different customer characteristics are going to be kept in there. So again, looking at ways of deciding, these are the parameters and characteristics one takes. Now, let me look at online sales and omni-channel retailing, because in reality, omni-channel retailing is when you use multiple channels to be able to interact with your customer and look at what they need and how to fulfill their requirement, which again is information always, products and funds, right? How they, so there are many alternatives when it comes into omni-channel, right? From face-to-face to home delivery, pickup to remote. And you know, there are from traditional retail to online information plus home delivery, to go pick it up, to showrooms and delivery or pickup. There are mixtures. Again, I'm trying to show you the variety that one has to make a decision. My hope and desire is that you see that it's not as easy as you might have thought initially, because there are so many options here to decide. And each of these, you know, from traditional retail, meaning face-to-face, and what are the advantages from high level of inventory to low transportation costs, going to showrooms and seeing what is in there. I'm not going to read this. Please make sure you take a look at what the book has offered you so you have a better understanding. When you have online information and home delivery versus online information and pickup, so you look at performances of each of these channels and looking at response time to customer, from product variety to availability to the customer experience, and you know, time to market to visibility to returnability to direct sales to customers to efficient fund transfer, inventory. Understand that there are so many different aspects, transportation and information, and you can look at a comparative analysis between these different methods and understand what their characteristics are. And depending on the type of business you are, again, through that DuPont analysis, one can go from one methodology to another to be able to make a decision when it comes for omni-channel retailing, and looking at, again, what type of product you're looking at and how do you want to interact with your customers, and you know, the type of infrastructure it requires, from information systems to what customers are, you know, how they behave and how conscious and informed they are, and what is their, and again, there are variety of customers that one has to look into. So when you look at product demand and seeing, you know, there are a fair amount of uncertainties there when it comes to omni-channel retailing. Please do take a look at the differences here and how product value and omni-channel retailing compare with one another, from low value products to high value products, right? From low information complexity to high information complexity. Again, within 90 minutes, we cannot cover 2 chapters in detail. My hope is that you at least have been told enough to be able to go and read your book and understand that there are a lot more to this whole process that meets the eye. Again, I don't expect you to memorize everything or nor to be able to understand every aspect or read every page, but to understand the complexity. When you understand the complexity, when it comes to making decisions and coming up with solutions, there you will be able to know at least where to go to for information and to understand that, oh yeah, I remember Professor Guyabadi was telling us that these are the determining factors. Hopefully you have enjoyed this lecture, and I have not tired you for listening to my monotone voice. But then again, my hope is you do read, understand the complexities, and yet hopefully you find it exciting enough and yet complex enough to be able to pay more attention, and it's worthwhile spending some time to read and understand it at least once. So if you ever have to make decisions such as these, you are prepared to do so. Do not forget, please, write well, reference, make sure you use scholarly resources and name those sources using APA format, and use Grammarly just to make sure your writing is at par with what we expect. Thank you so much, and hope to talk to you soon next week. Take care.